Hello, savvy investors, and welcome back to the Dividend Uncle channel. In today's episode, we're diving into a topic that's not just crucial but also deeply personal to my investment approach, dividend investing. I will be taking a reflective journey back through my 20 years of investing, on why I persist in investing in REITs and dividend stocks. We'll explore real-life investments from my real portfolio to uncover the enduring value of dividend investing, especially in light of the recent outperformance by growth stocks. Join me as we delve into the crucial insights garnered from decades of dividend investing and why it remains a cornerstone of my investment philosophy. Turning tides, how dividends offset price depreciations. Throughout my investment journey, I've seen firsthand the compounding power of dividends. Even when stock prices faltered, consistent dividend payouts played a crucial role in not just safeguarding, but enhancing my portfolio's overall value. These cases highlight how dividends can serve as a resilient force, offering a silver lining during market downturns and price volatilities. Now, let's focus on 3 specific investments in my portfolio. Each of these tells a unique story of how dividends have not only offset price depreciation but also contributed to overall gains, underlining the resilience and rewarding nature of dividend investing. First up, we have Lendlease Global Commercial REIT. Facing a challenging environment, the REIT saw a decline of almost 40% since its IPO in 2019, when I first invested in it. Yet, the story doesn't end there. With dividends received totaling $3,300 over the years, the narrative changed. These consistent payouts, including the dollar cost averaging I did, effectively reversed the price loss. Now, I am in the black, having a profit of $2,000. This illustrates how dividends can act as a buffer and a source of positive returns amidst market fluctuations. Next up, let's talk about QAF, the staple food giant behind the beloved Gardenia brand. Over the past 10 years, while its share price has declined a modest 11%, the dividends told a different story. With $7,000 received in dividends, my investment journey with QAF painted a picture of stability and growth. The dividends not only covered the price drop but also added a layer of profit to my holdings, putting me in the black of $4,400. Next up is CapitaLand China Trust. The market hasn't been kind due to the negative sentiment over anything with China exposure. Over the past 5 years, it has a price depreciation of about 50%. For many people, this may seem a horrendous investment outcome. Well, I'm not going to sugarcoat this. The dividend uncle is about $10,000 in the red, and I repeat, in the red, for this REIT inclusive of the generous dividends received over the years. However, let's look beyond the surface. Excluding the steady dividend payouts amounting to $12,000 during this period, my paper loss would have been a whopping $22,000. While the $10,000 paper loss is terrible, but this is my point, if the price is dipping, the dividends play an even more important role in propping up my portfolio's performance. Anchoring through uncertainty, the steady promise of dividends. Beyond the financial benefits, dividends have been a source of stability and psychological comfort in my investment strategy, especially during periods of market volatility. REITs and dividend stocks can provide a predictable stream of income, reinforcing the value of patience and strategic planning. In the tumultuous sea of market volatility, especially during the recent downturn faced by REITs due to rising interest rates, the unwavering lighthouse has been the steady and, in some cases, growing dividends from stalwarts like Mapletree Logistics Trust and CapitaLand Integrated Commercial Trust. Let's look at how these REITs have exemplified the stabilizing power of dividends. Mapletree Logistics Trust, despite the market's rollercoaster ride, has managed to not only maintain but also increase its dividend payout. With a dividend yield of around 6.4%, the trust announced dividends that grew by 1.2% year over year, even as its share price experienced fluctuations reflective of the broader market's unease. This growth in dividends are a sight for sore eyes for my portfolio undergoing seesawing along with the market volatility. Strategic acquisitions and an enhanced asset portfolio underpin the REIT's resilient income generation capabilities. Similarly, CapitaLand Integrated Commercial Trust has stood as a bulwark against market volatility and is the stabilizing force for my investment portfolio. As the largest retail and office REIT in Singapore, its dividends have been a bedrock of stability for investors. With a dividend yield of 5.6%, The trust increased its dividend payout by 1.6% compared to the previous year. The beauty of investing in a diversified REIT like CapitaLand Integrated Commercial Trust is that when one sector is lagging, the other sector can help support the growth of the REIT. During the COVID crisis, retail sector was wavering due to restriction controls, but the office tenants continued to pay rentals. Now that COVID is largely behind us, retail is booming again, supporting the slightly less favorable office sector with work-from-home realities. These real-life stories of stability happening right in my portfolio underscore a crucial lesson. While share prices may ebb and flow with the market's tides, dividends from well-managed REITs like Mapletree Logistics Trust and CapitaLand Integrated Commercial Trust can provide a steady stream of income. The Dividend Uncle's Take, a balanced perspective incorporating dividends and growth. Reflecting on 2 decades of investing, it's clear that a balanced portfolio is key. The recent outperformance of growth stocks has captured many investors' attention, but the lessons I've learned underscore the importance of including dividends for their income and stabilizing effects. The choice between growth and dividend investing isn't binary. It's about understanding how each fits within your broader investment goals. For those nearing retirement or who prioritize a stable investment portfolio, tilting your allocations towards dividend shares and REITs might be a strategic move. Reflecting on my own portfolio as a 45-year-old, as I shared in a previous video, 50% is dedicated to dividend shares and REITs, with 25% in growth stocks, and the remaining 25% in bonds. This mix offers a blend of stability with the potential for significant growth, ensuring both peace of mind and space for wealth expansion. For younger investors or those with a higher risk appetite, you might find a more aggressive stance towards growth stocks appealing. But even in the pursuit of growth, dividends should not be overlooked. They serve as a foundation for long-term wealth building, providing regular income and compounding opportunities, regardless of market conditions. Conclusion. The tales of Lendlease Global Commercial REIT, QAF, CapitaLand China Trust and others from my real portfolio highlight a crucial investment insight: dividends matter. They're not just icing on the cake, they're a critical component of your investment strategy, especially in times of market downturns. These examples from my portfolio underline the significance of selecting dividend-paying assets as a pathway to transforming losses into gains. So, before you get swayed by short-term price movements of growth stocks, remember the long-term power of dividends. They might just be the key to turning the tides in your favor. If you found value in this deep dive into the resilience of dividends, make sure to like, subscribe, and share your thoughts in the comments below. Your support fuels the creation of content that empowers you, the savvy investor, to make informed decisions. Until next time, stay invested, stay informed.